Meanwhile, the market's under pressure today, but year to date, we've seen all three major indexes reach record levels, with the S&P already blowing past some street estimates thanks to a solid earnings quarter and the AI rally. There's been talk of a bubble, we know, popping at some point, but our next guest believes there's still more room to run. Eric Freedman is the U.S. Bank Asset Management Group's CIO. Eric, it's good to have you on the show. So maybe we just start there, because that's certainly a question that's been raised. Eric, people, they've been looking at NVIDIA and this AI rally, and you're hearing these questions. Maybe we're seeing a bubble, but you don't think that. Things don't look bubbly to you.
They don't. And Josh, thanks so much for having us on. Look, as someone who lived in San Francisco during the dot-com rise and fall, maybe I'm a bit jaded by what a real bubble looks like. We think there's just a really tight supply of services in AI right now. Specifically, if you look at the core producers, the OEMs, if you will, they just can't get product out fast enough. And so we do think that demand will be steady. And if you also look at what backs up this AI move, it is continued corporate CapEx. Companies are looking at bigger, stronger, faster. They're not doing that through hiring more people. They're doing that through technology spend. So again, as you have constrained supply with still very steady demand, we think there's going to be an ongoing bid there. And we would there are lots of things to fight in global macro. That's not one thing that we would pick a fight with right now.
And so not picking a fight and sort of investing more in it are two different things, right? So would you put more money to work in that theme right now?
Yeah, Julie, I think as things settle back, if we do see a retrenchment, even all the areas that you've talked about, whether that's equal weight or small cap or certainly AI space, we think there is room to run. So this is very much an interest rate driven story in the near term. And we have right now in front of us a really important technical level. Shauna did a nice job of covering this in the prior segment. But as we get closer to 435 in the 10-year, that begets 4.5%. 4.5% is a very, very key level for both the Fed to issue more concrete guidance. We'll certainly get those dot plots next week. But we do think that with more moderating interest rates and the bias for the Fed to cut back, we think that sets up a good opportunity to get to stay involved or get involved if you're not involved.
And Eric, for equity investors listening right now, I know you favor, it looks like, domestic over international. Sound a bit nervous there, Eric, as a lot of people are about China. I've seen some strategists on China, Eric, they kind of push back on that. I know it's kind of contrarian call, but they say, valuation now looking attractive, but you don't see that.
China has been a great excess return source for us for several months. And anytime you're underweight something, you have to have some nervousness attached to it. That's really where we are right now. There's not a great fundamental reason beyond a ton of liquidity injections from the central government. The property market is still upside down. You look at where core demand is from a consumer standpoint, it's just not there. So the reason that China is really moving up is because it's been down so much. I mean, when you're down 45%, which again has been great to be underweight, there may be a bit of a reflexive move higher. So again, it's an area where the information is not great coming from China, but the fact that you've had just such a move lower, probably a little bit of a consolidation makes sense. We'd still remain underweighted. We think there are other opportunities out there and not a great fundamental story for some time in China.
So we talked about where you do see opportunities here in the U.S. in terms of sort of the tech AI trade. I know you like consumer discretionary and healthcare as well. Just briefly, what are the sort of thinking behind those?
Yeah, I think on healthcare specifically, this is something that, Julie, there's this ongoing, let's call it demographic tailwind that's very hard to move past. In other words, you've got a broadening out of an aging population. You have more value-added services being delivered, whether that's in pharma, whether that's in things like biotech. If you look at PBMs, if you look at a variety of the service intake for healthcare, it just hasn't been rewarded. And that demographic trend we think is going to be very slow to let's call it curtail. So we think it's hard to bet against demographics. This is an aging population with still some degree of growth. So we'd stick with healthcare. Consumer discretionary, we think this is a story of the big getting bigger and really consolidating down the overall environment. So we think this is a space where you can get involved in some of the larger consumer discretionary. That is really the hub, if you will, of CapEx and the changing experience for consumers. So those are two things that we think the big get bigger and continue to get stronger in both spaces.
Eric Freedman, thanks so much. Appreciate it.
Great to be here. Thank you.